Hello, everybody. My name is Luke Robinson, and I'm a business advisor here at Collective. And Collective is essentially your self employment tax factory. We pretty much handle it all. You can think of us as kind of like an all in one solution for a small business owner, specifically a small business owner that needs to have an S Corp or who needs an S Corp election. We would handle getting it set up, setting up the LLC, making the S Corp election, running your payroll on an ongoing basis, running your bookkeeping on an ongoing basis, uh, advisement and support throughout the year. And then at the end of the year, we'll file your S Corp tax return. So when it comes to the business, we pretty much do the whole shebang. But today, or every Tuesday, rather, we run a session we like to call Tax Tuesday. And essentially, it's an AMA. It's an Ask Me Anything session where you can ask me anything about taxes, about business finances, about business best practices, things of that nature. So let's get into this. And before we get into it, it's important to note that this is just information. Don't consider this like none of this should be construed as actual tax advice or legal advice or anything like that. It's always a good idea, like before acting on any of this information, to speak to a tax attorney, a CPA, or some sort of licensed or credentialed tax professional before doing anything. But now that we have that out of the way, let's get started on some questions. And the first one is a very good one that people ask a lot is, do I need an LLC for my business? And the answer to that depends on a couple things. First off, let's discuss what an LLC actually is. An LLC is a business entity. It's a business structure. And you set it up with your state. You set it up with your Secretary of State's office. And what the LLC does is essentially it legally separates your business finances from your personal finances. So when you're just a sole proprietorship, like when you don't have an LLC set up and you're just kind of doing business based on like just your social security number and without any sort of business entity, all of your sort of personal assets and other sources of income, personal income, creditors can go after that. Some sort of business lawsuits can go after that. When you have an LLC, it prevents a lot of that, or it should. It provides legal separation. And if there's not a good reason, typically a creditor or someone like that can't go after your personal assets if they were to ever sue your business or anything like that. So that's really kind of the main reason why people will set up an LLC. But also, in order to be an S Corp, you have to be an LLC first. You have to have some sort of business structure like an LLC before you can even make an S Corp election with the IRS. So sometimes people don't necessarily need the legal protections of the LLC so much, but they need to be an S Corp because of the tax implications and the financial benefits. So they'll set up an LLC just for that purpose and make an S Corp election. So those are the two kind of things that determine whether or not you need an LLC. All right. What's the difference between an LLC and an S Corp? Very good question. Technically, there's not really a difference because in order to be an S Corp, you have to be an LLC first, or you have to be some sort of business entity first. So you have to have an LLC set up. You have to have a corporation set up. And either of those entities can elect to be treated as an S Corp or be taxed as an S Corp. But the reason that you want to do that is before you become an S Corp, like when you're just an LLC, typically a huge chunk of your net income or all of your net income is subject to the self-employment tax. Self-employment tax, it's a flat tax rate of 15.3%. That's what it is. Literally what that is, like the self-employment tax, is just another word for Social Security and Medicare taxes. It's what they are. So that 15.3% is literally made up of Social Security and Medicare taxes. And before you become an S Corp, those Social Security and Medicare taxes are subject to a huge chunk or all of your net income. So let's say that, your business is making like, $100,000 a year. Before you become an S corp, essentially how you come up with your self-employment tax is you take 100 grand and you'd multiply it by 15.3%. But what happens with an S corp election is technically, and that's paperwork filed with the IRS, by the way. It's done with the feds. But what happens is you essentially become an employee of your own business. Pretty long story short. Now, obviously you're still the owner, like it's still your business, but for tax purposes, you literally become an employee as well. And now that you're an employee, you will pay yourself a salary. Like, you'll pay yourself a wage, just like you'd receive, if you work for somebody else as a W-2 employee. But the cool thing about S corps is that the only chunk of your earnings that's subject to the self-employment tax is your salary amount. So, for example, let's say that you, like I said, like let's just assume that someone's netting around $100,000. But let's assume with the S corp, let's assume their salary with an S corp is like $40,000, somewhere around there. That first 40 grand is still subject to self-employment tax. You still pay it. The other 60 grand, or just the rest of your money, like outside of your salary, those are considered distributions to yourself. And conceptually speaking, you can kind of think of that money as dividends almost. Like some people will use that term. But long story short, that chunk of your earnings are no longer subject to the self-employment tax any longer. So, assuming that you make that much money, an S corp it'd save you somewhere between $9,000 and $10,000 a year in the self-employment tax. So, like when someone reaches a certain income level, it typically is a pretty good idea, to go the S corp route. I got a letter in the mail from the IRS on what I need to pay. Am I screwed? Well, not necessarily. You're not necessarily in trouble. Now, there's a few things you can do. For one, read the letter and understand it. Like, really try to understand what they're asking for, what's going on, because that letter could be multiple things. That letter could be from the result of an audit that you didn't show up to, and that the IRS is just assessing tax. Or that letter is just a letter for an unpaid tax bill. Let's say that you filed your personal return or something, you owed some tax and just didn't pay it. The IRS will eventually send you a letter, demanding full payment. But you're usually not screwed. And the reason that is because, especially if the amount is under a certain balance, usually it's $50,000. Then, and again, the laws could have changed, so it could be different now. But typically, if a balance is under $50,000, the IRS will usually give you an automatic 72-month payment plan if you apply for one, if you request one. So, let's say that you owe 10 grand. You could probably get a monthly payment of around like $138 to pay that off. Now, it's a good idea to pay it off as soon as possible, because you have penalties and interest that accrue and whatnot. So you can always make extra payments. But usually, as long as you work with them, the IRS is pretty reasonable when it comes to payment plans. Now, let's say that if you just ignore that letter, let's say that months go by or a year goes by and you just don't pay it. Eventually, they have the right to levy you. They have a right to take money right out of your business bank account or your personal bank account, your business bank account. They have the right to garnish your wages, your paycheck. They can do that. So it's a good idea to pay that as soon as possible, or either get into an official payment plan with them as soon as possible. Because when you're in a payment plan, a vast majority of the time, they can't levy you, they can't garnish your wages. So at the very least, get on a payment plan. I haven't done my taxes for last year, and TurboTax keeps sending me emails for the deadline. Can I still do them after the deadline? Yes, you can still do them after the deadline. You can still file your return, and you should file your return as soon as possible. Just in general, it's just a good idea to file the tax return as soon as possible. But yes, you're totally fine to still do it after a deadline. You'll just likely owe, more in late filing penalties, in late payment penalties if you haven't paid, et cetera, et cetera. But yeah, you can still file. How do you make a payment plan? Well, there's a couple ways you can do it. A lot of times you can go on the IRS website and set up a payment plan online to where they'll ask you, some information about your social security number, about, your tax information, things like that. And you can usually set one up right online. Another way is you can send in a form. You can go online for a payment plan form for the IRS and you can mail that into the IRS, or you could call them. You can call their customer service line, which takes forever. You might be on the phone for 2 hours, but you can do that. Also, sometimes when you file your return, you when you file a tax return, you can request a payment plan right on that tax return. If you can't pay your balance, you can put in your bank account, automatic draft information, and you can apply for a payment plan. Why is S corp better than other formations? Well, it could be better than other formations. And first of all, an S corp isn't really a formation; it's a tax election. Your formation happens when you form an LLC or a corporation or something like that. Like when you form some sort of business structure with your Secretary of State, um, Secretary of State's office. But an S corp is a tax election on that formation or those formations. But like to answer your question, like why is an S corp better than other tax situations? It depends. If you're in if you're in an income level between 100 grand, like up to a half a million, usually the S corp is a pretty good benefit just because of how it works out with the self-employment tax and whatnot. But keep in mind that there are restrictions to having an S corp. And one restriction is you can only have up to 100 owners, up to 100 shareholders in an S corp. And those shareholders must be permanent residents of the United States. Like they can't be they can't like live out of the United States and not have citizenship or any sort of resident status here. So, that's one thing. And especially, people that are want to get involved in financing, raising money for their business or stock, like issuing stock and things like that. Sometimes they might not want to go the S corp route because you can only have up to 100 shareholders. But that just typically doesn't apply to a lot of small business owners. What are some S corp success stories you've heard of? Well, shameless plug, but I'm a business advisor here for Collective, and my job is to speak to prospective Collective members who have businesses that are interested in becoming an S corp, and we'll run an analysis. Like, we'll see if they need to do it. We'll see exactly when they need to do it, and so my success stories, I hear them every day, and I hear them especially after a client has been a client of Collective for a while, and they see how much money they've saved with the S corp. I see quite a bit of success stories come in every day. I haven't done any accounting all year. How can I make sure my accounting is okay? I don't remember what expenses went where. Well, unfortunately, when you're in this situation, you've got to go back and do some drudge work. You've got to go back and do some busy work. So compile all your bank statements, all your credit card statements, any receipts you have, and go back, look at each transaction and try to remember if it was for business and what it was for. And you just go back, highlight them all, make a spreadsheet, input everything. And typically that's how you do it. But with Collective, keep in mind that we take care of that for you. So just to ensure that you don't like have to deal with that situation again, Collective will close out your books month to month. So each month will give you a profit and loss statement, a cash flow statement, and a balance sheet, each month for the books. So if you come on board with us, you won't have to worry about that again. In what situations would you want to be a C corp over an S corp? Well, keep in mind that a C corp can make an S corp election. So you can still be a C corp and have an S corp election, so to speak. But there might be situations where you want to form a C corp and not make the S corp election. I think that's what the question is. And the reason that is kind of like I mentioned earlier. Let's say that you want to fundraise or have, over 100 owners into your business, then then a C corp structure might be the way to go. Or let's say that you want to transfer ownership to somebody else, or like for whatever reason. Sometimes C corps can be easier in transferring ownership and whatnot. So, like, there's a couple of reasons why you might want to go the C corp route, like over the S corp route. Okay. We have a question come in. Can a partnership be an S corp election? Yes, a partnership can be an S corp election. Now, keep in mind that a partnership is literally just two or more people on an LLC. That's what a partnership is. So if you form a partnership and you don't do anything, you're automatically considered a partnership in the eyes of the IRS. Like, you're taxed as a partnership, which means you now have a partnership tax return that you got to file, everything like that. So just keep that in mind. But also, when you make an S corp election on a partnership, instead of filing a partnership return, you will now file an S corp election return. So, or an S corp tax return. So that's just kind of how all those things work. Is it true that most S corps need to make 60 grand in profit? Well, what we say is generally we we recommend that you have at least 60 grand in profit before you even go the S corp route. So that's kind of where that comes from. And the reason that is because when people are making around 100 grand in in their business, or I'm sorry, 60 grand in their business, and they make an S corp election, generally between they're usually saving around $5,500 a year in the self-employment tax. Now, collectives fee, especially if you go the annual route, comes out to around $3,500 a year. So it's kind of a good rule of thumb to say, okay, if I'm at least making this much money, then what I would save with the S corp will overtake collective's fee, will be more than collective's fee. So essentially, you're saving more money than what you're paying. Now, people still join collective, like even if they're below that 60K mark, because they want support with everything else. Like, the tax savings are less important to them. They'll probably break even anyway with how much they're saving with the S corp and how much they're paying us. So it it usually makes sense when you're at least at that income level. How can I decide what to pay myself through my S corp? That's a really good question, because the salary amount is a really important compliance piece of the S corp. Because people will ask me that, they'll say, okay, well, if I'm only subject to the self-employment tax on my salary, then why not just pay myself like a super low salary, like a dollar salary or something like that. And what I have to advise them on is like, well, the IRS says the salary must be reasonable. So let's say that if your business is making like 100,000 and you pay yourself a dollar or something like that, specifically in salary, then it's likely that the IRS might audit you because they would say, okay, that's not a reasonable salary. There's no way that that justifies with how much money the business is making. There's no way that that can be justified. So they'd probably audit you, request some information on how you came up with that salary. And then they might disagree and reclassify things as distribution or as salary, charge you a penalty. It's not fun. So, yeah, that's what the IRS says is that the salary has to be reasonable. Now, what does that even mean? What does reasonable even mean? Well, we don't know. There is no official measure to come up with a reasonable salary. The IRS doesn't give any sort of objective method or anything like that. So you have to come up with your own. And some common, I guess, weights in the equation on coming up with the salary is, okay, where do I live in the country? How many hours a week do I work in my business? What are other professionals? What are they making in my same industry with similar experience, things like that. So there's several things that go into coming up with a reasonable salary. All right. Can a nonprofit become an S corp? No, they can't. But also, there probably wouldn't be a reason that you'd even want to make an S corp election on a nonprofit because a nonprofit they're typically not taxed. Like the income of the nonprofit is typically not taxed. So there'd be no reason to like reduce self-employment tax um, when you're not subject to self-employment tax anyway. How to file indicating backdating the election to July 1st. Well, really, the only how you file an S corp election and you backdate and you backdate it to the date you want is you simply list the effective date that you want your S corp election to start on your S corp form on the form 2553. But also keep in mind that it's late. This is a late election. You're supposed to make it by March 15th of every year in most situations. So you're going to have to put a reasonable cause argument on there as to why you're making it late. Then once you do that, you might need to run back payroll with some of your money. You might need to go back and edit your bookkeeping to uh, include a balance sheet and things like that. So there's a lot of things that are involved in backdating an S corp election outside of simply filing the form. So I would very much encourage you to get some assistance with from a tax professional. And obviously, since I'm here repping Collective, I would recommend Collective. And please feel free to schedule a call with us. Like, go to our website, reach out to us on here on Instagram, and schedule a call with an advisor. And we'll go through, whether or not you even need to be an S corp, how Collective can help you, and just some other good resources in running your business. How can we ensure we're always paying low taxes? Well, just to make sure that your finances are optimized, which is, kind of the obvious answer. But that's pretty much what it is. And what I mean by that is make sure that your bookkeeping and write-offs are optimized. Research tax law, research what you can and can't write off, and take advantage of all the things that you're paying currently now anyway that you can write off in your business. So that's one thing to ensure that you're paying low taxes. Another thing to ensure that you're paying low taxes is to pay your taxes on time. Because if you don't, you are charged unnecessarily, goodness. unnecessary penalties, like late filing penalties if you file your tax return late, like late payment penalties if you pay late, things like that. So in effect, it just increases your tax bill because it increases your penalties and interest. And then make sure that you have the right tax election. And essentially what I mean is make sure whether or not you need to be an S corp. Essentially, that could drop thousands of dollars off your tax bill. So those three things are the big things to look out for when you're interested in paying lower tax. Does the S corp reduce your income tax? No, typically it does not. So usually the S corp only um, decreases the self-employment tax, the 15.3%. The income tax is something completely different. The income tax is a marginal tax rate, and that's what most people think of when they think of taxes. But essentially, like with the income tax, a part of your income is charged this rate, a part of your income is charged another rate. But the self-employment tax is just a flat tax rate. It's a flat 15.3%. The self-employment tax gets reduced with an S corp election, but typically not the income tax. Okay, I think I have time for one more question here. Why should you not make an S corp election? Well, we've already, or when should you not make an S corp election? We've already discussed some of these, but one we didn't discuss is your income levels. Like, if you're making below a certain amount, then usually an S corp doesn't make a lot of sense because the amount of savings that you get might not even cover the administrative cost that you get when you go the S corp route, like payroll cost, the S corp tax return costs, et cetera, et cetera. So if you're not going to save money above how much it costs you to be an S corp, then what's the point? Of having a more complicated tax situation when you're not getting a lot of financial benefit from it. But that's all the time that I have left, unfortunately, today. I actually have to run and go speak to a prospective collective member. But like I said, like if you thought this conversation was helpful for you, if you think an S corp might be in your best interest, schedule a call with us. No pressure, by the way. Of course, we'd love for you to join collective, but if you feel like it's not the right fit, if it ends up really not being the right fit, if somewhere else might be a better fit for you, we'll tell you. We'll give you some referrals. We'll give you some good next steps, suggestions for your business, and we'll go from there. But thank you guys so much for joining this week, and I'll see you next week.